Hello aspirants, I Shubham Sharma welcome you all on KGS IAS English YouTube channel, and today I am starting with this economic survey series extremely important for UPSC Prelims as well as for mains exam. What I'm doing in this particular series, I'll cover the economic survey chapter wise from chapter number 1 to chapter number 16. After the end of each chapter, I'll discuss some questions related to that chapter so that you people are aware of how we need to cover these chapter and what kind of questions UPSC may ask in prelims from this economic survey. So let's start the session. Chapter number 1, state of the economy pushing the growth frontier. So it usually talk about what in this chapter. If I'll give you an overview, this chapter talk about what is going on in the whole world after this uncertainty that is prevailing right from last couple of years. Apart from that, it also talk about how Indian economy becomes so resilient in that. So first of all, if we talk about the global economic environment, geopolitical tensions, you all know after Trump become the president, geopolitical tension keep on increasing, like increasing the tariffs, recent wars as well. Then trade disruptions, because of all these problems trade also get disrupted. And lastly, divergent growth and inflation outcome across major economies. So basically, global tariff shocks and their impact, that is extremely important. First is reciprocal tariff announced in April 2025. It raises the fear of lower growth and higher inflation. However, in short term, they prove to be transient. Why? Now, these four factors are extremely important. Why these fears actually prove transient? First thing, different countries knew this fact that if the tariff increased by the US government, it will create a major dent on their export. So what they are doing, they initially do the trade agreements between themselves to reduce the effective tariff rates. Second, US households and firms increase their spending. They actually raises their demands, which led to more import by US economy. Third, business delayed the price increases. All the businesses knew this fact that if we continuously increasing the price, we might lose the customer base. And fourth, exports were advanced before these tariff took effect. Either that means the exports were already being made when the impact of tariff is being made by the US. Now, if we talk about the state of Indian economy, this is very important image. If we talk about in context of GDP growth, the GDP growth from 2023 is 7.6% at constant price. Then it is around 6.8 to 7.2% that is projected in 2026-27. Per capita income, if we talk about, that is on 2.20 in lakh rupees at current price. Agriculture growth little bit shrink in comparison to 2025-26. Industrial growth increases. Service growth as well is also increasing. The foreign exchange reserve is also increasing from $578 billion, and it is around $701 billion. Fiscal deficit, it is 6.7%. That is high in during the COVID times, and it is now reduced to 4.8%. This is just a facts that you guys should know, that the GDP growth is projected to 6.8 to 7.2%. Agriculture, livestock, forestry and fishery growth is actually shrink. Industrial growth rises, service growth rises, and forex reserve is around $700 billion in 24-25, and fiscal deficit 6.7% to 4.8%. Now, this is the most important slide in this particular chapter number 1. Real GDP growth for financial year 2026 is 7.4%. GVA growth financial year 2026 is 7.3. Now, what is potential GDP? A prelims question that can be asked. Potential GDP means maximum GDP without triggering the inflation. That maximum output our economy can produce without triggering the inflation, that is potential GDP, and using the full employment level. So potential GDP is now firmly anchored around 7%, which is essentially getting more output from the same amount of labor and capital with better technology and clearer process. Remember this thing, when the real GDP increases from potential GDP, the inflation increases. And when the real GDP is fall of potential GDP, then economy is not utilizing its resources efficiently. So potential GDP is now firmly anchored around 7%. So fastest major growing economy. This is again a prelims fact that UPSC may ask. First of all, they will ask you what is the potential GDP. Second question, they may ask what is the real GDP growth financial year 26. GVA growth financial year 2026. Real GDP growth means that adjusting the inflation effect. GVA is value additional growth. Then India is the fourth growing major economy for fastest growing major economy for the fourth consecutive year. Extremely important statement. India is the fastest growing major economy for the fourth consecutive year, and growth is largely driven by domestic demands, not by export. Guys, this particular slide may have one question in this year prelims. This is my personal opinion. The first thing is that the growth in India is largely driven by domestic demands, not export. Might be UPSC will ask a trap question that growth is largely driven by export. No, it is by domestic driven demand. Then again, a extremely important word, that is what is Goldilocks phase. The economy is in a Goldilocks state, that means balanced growth that is strong and stable. This is again very important word, Goldilocks zone, that means a balanced growth and stable economy. Manufacturing competitiveness, if we talk about, it is aggressively pursuing the disciplined Swadeshi to lower input cost and integrate with global value chain. We all knew this fact that government of India is continuously focusing on enhancing the manufacturing growth in overall GDP, and it is our target that if we want to become a developed nation by 2047, the contribution of manufacturing in overall GDP should be around 25 to 30%. And for that, we are focusing on PLI scheme, we are focusing on Make in India as well. So to enhance our manufacturing competitiveness, India is focusing on disciplined Swadeshi, that is focusing more on producing the goods in through Make in India, and also procuring raw material and making the finished good from India only. So the strategy is to adopt lower input cost and integrate with global value chain, because we considering ourselves as an alternative to China, and that's why whole world is expecting a lot from India. And that's why there is a concept continuously emerging, that is China plus one strategy. Moving ahead, if we talk about the demand side, that is consumption side, we have two components here. One is demand side, that is consumption side, and another is supply side. So if we talk about the demand side consumption, private final capital expenditure is around 61.5% of GDP. See, to make a economy more demand driven, it's quite essential that the demand should be both from public as well as from private sector. Now if we talk about the private final consumption expenditure, it is around 61.5% of GDP, which indicate that there is a confidence in the economic system, which also shows that the people's real income increases, and it also talk about the inclusive and holistic growth. Now what are the drivers behind this particular growth? The drivers behind this particular growth is low inflation, stable unemployment, and enhancement of rural income from agriculture as well as urban tax rationalization. So this is again a very important part, that why this demand side consumption increases. The demand side consumption increases because of these four factors, that is low inflation. This is again very important, that the inflation is low. Apart from that, stable employment factor. Then if we talk about the third one, that is rural income from agriculture and urban tax rationalization. This is regarding to demand side consumption. If we talk about the investment part, because this investment part is again very important to form the capital formation. If we talk about the virtuous cycle of economy, when the demand increases, the production increases. When production increase, employment increase. With increase in employment, the income increases, which enhances the saving, which enhances the investment, and it led to capital formation, which led to overall GDP growth in the economic system. So investment gross fixed capital formation is at 30% of GDP. Now this gross fixed capital formation is again very important. That simply shows that focusing more is on fixed capital assets. That means which will generate long-term returns. As a result of that, the government is trying to enhance this GFCF. That means capital expenditure should be promoted and fixed capital assets need to be built more, because they will generate long-term returns as well as provide more employment. So public capex crowding in private investment, यानी just the public capital expenditure जो लगातार increase हो रहा है, it also enhances the private investment. Why? Because whenever the government is increasing the public capital expenditure, the private people know this thing that it will generate more opportunities, more demands. So they are also trying to capitalize this particular thing. As a result of that, public capital expenditure and private investment both chip in together and enhances this investment. Then healthier bank's balance sheet. Now this is again a component that is always in news, that the bank's balance sheet shows lot of NPA, non-performing asset. But here, if we talk about the investment perspective, the bank's balance sheet is showing on a healthier note, which shows that the banks are now become more resilient, and thanks to the this bad bank concept and insolvency bankruptcy code too also. Then investment cycle turning durable. The investment cycle is focusing on long term perspective, which shows that the investment in general will increase and will also promote the capital formation. Now, if we talk about the supply side, the broad based growth in real GVA. This is again very important, that may be asked in prelims exam. So if we talk about the financial year 16 to financial year 20, then this is yellow. This yellow bar shows that financial year 16 to financial year 20. Provisional estimate, that is financial year 2025, is reflected by blue, and financial year 2026, that is advanced estimate, is by green. So total GVA 6.4, it increases to 7.3. Agriculture GVA is little bit falling. Industrial GVA is increasing to 6.2, and service GVA is increasing to 9.1 as well. Now friends, if we talk about the supply side, why the supply side is extremely important? As you are aware of this thing, that inflation can be caused by two particular side. One is demand side, another is supply side. Now demand side can lead to demand pull inflation. When there is aggregate demand is increasing, that led to demand pull inflation. But India is facing more of this supply side inflation as well. Now supply side inflation is depending on how the supply chain is, whether the supply chain is effective or not. So thanks to this these particular sector, that the service, that the supply side is also keep on with momentum. So agriculture growth is stable, but moderate. But issue in agriculture is structural productivity constraint. Along with that, allied activities reduce volatility. Now why this structural productivity is the major issue? Because the post harvest loss keep on increasing. We have lack of storages, we have lack of warehousing things, we don't have the most modern infrastructure, and still Indian agriculture is more monsoon driven. So agriculture's structural productivity constraint persists because of post harvest losses. Then allied activities will reduce the volatility, although the allied activities that support the agriculture sector will somehow reduce this volatility. And for that, the animal husbandry sector is contributing good in that. Industry, if we talk about the industrial part, manufacturing growth is strong in real terms. Manufacturing growth keep on increasing, and for that we are so much dependent on PLI scheme, Make in India, Atmanirbhar Bharat, and incremental sales part is more rewarding right now. Then declining nominal share due to price effect, that is not that much relevant. Output remain robust. The output is robust right now. Service sector, that is the backbone of Indian GDP growth. So service, we talk about the core growth engine, highly value added, strong export. It also contribute a lot in export income, and digital and professional services are leading in this particular segment. Now inflation. First of all, we should know what is the meaning of inflation. Inflation means sustained rise in price of goods and services over a period of time. It can be caused by demand pull as well as cost push, as I mentioned. And inflation targeting is done every 5 years by central government on the recommendation of RBI. Currently, the inflation targeting is 4% plus minus 2%. So if we talk about the inflation rate is around 1.7%, that is significant because it signals sharp disinflation. Now friends, inflation targeting, that means 2% to 6% is what we are considering. But right now the inflation rate according to survey is 1.7%, and which shows a signal of sharp disinflation. May I know in the comment section what is the meaning of disinflation? So disinflation means the prices keep on increasing, but the percentage change in the prices keep on falling. What is inflation? In inflation, the prices increases and the percentage change in price also increases. So in disinflation, the prices increases, but the percentage change in prices actually fall. So this indicates that our price pressure in the economy are very weak, creating both opportunity and risk for macroeconomic management. Now, what are the causes of disinflation? Why disinflation is actually happening? The first is food price correction. The food price correction is the first thing. Food items have high weight and CPI inflation. Now, inflation can be measured through WPI and CPI. What is the core difference between WPI and CPI? WPI cover only goods, CPI cover goods and services. And in this CPI, the major share is for this food item. Okay, so if food price correction, good agriculture output, improved supply chain, and easing of earlier shocks have led to fall in food prices. We already have this kind of thing in mind that whenever there is any problem regarding to supply chain bottlenecks of fresh fruits, vegetables, it will increases the inflation. Now, but because of improved supply chain and because of the schemes like top scheme, tomato, onion, potato, top to total, operation green schemes, all these things will ensure that there must be a continuous supply chain. If there is continuous supply of food items, obviously the CPI inflation will not rise above the level. And when I'm talking about the inflation targeting, that is 4% plus minus 2%, it actually talk about the CPI inflation only. So food price correction. Second is supply side management. Government intervention is actually helping a lot in reducing the price pressure. The first thing is buffer stock that is maintained by Food Corporation of India, import export policy adjustment, then anti-hoarding measure. This anti-hoarding measure helps a lot because of hoarding there is increase in artificial price, so that is also helping a lot. That anti-hoarding measures and logistic and distribution improvement, government of India keep on focusing on this part that we need to reduce the logistic cost. Currently the logistic cost of India is around 13 to 14% of GDP, and if we talk about the developed economies logistic cost, that is around 7 to 8% of GDP. So government is focusing on developing this logistic improvement as well. Apart from that, inflation is measured year on year basis, that is through the base effect. Then if prices were high in the previous year, current inflation appear lower. That's the basic economy. Moving ahead, then let's talk about the fiscal policy. Fiscal policy, the policy related to revenue and expenditure of the government, and this particular fiscal policy is extremely important when we talk about the inflation. If inflation is there in the economy, government focuses on contractionary fiscal policy by increasing the taxes and reducing the expenditure. And if there is a slowdown or recession is going on, government follow expansionary fiscal policy by increasing the expenditure and reducing the taxes. So in fiscal policy, if we talk about, they are talking about rising tax buoyancy. Now, what is the meaning of tax buoyancy? Please mention in the comment. Tax buoyancy means that increase in tax base in comparison to GDP. मतलब GDP में tax का contribution बढ़ना without changing the tax rates. टैक्स रेट्स को चेंज करे बिना भी जीडीपी में ओवरऑल टैक्स का शेयर इंक्रीज होना, दैट इज टैक्स buoyancy. And how this tax buoyancy improve? When the tax system become more citizen friendly, when the tax administration is becoming smooth, when like honoring the honest platform. Apart from that, when the tax system become less complex, all these things will actually enhances tax buoyancy. Then capital expenditure is prioritized. What is capital expenditure? Those expenditure which is asset creating, like creating infrastructure is the capital expenditure. And revenue expenditure is controlled because revenue expenditure is a kind of recurring expenditure and it is non-asset creating. For example, paying subsidies or paying salaries, or let's say an expenditure that is paying of pensions. This is all revenue. Law and order expenses, this is revenue expenditure. Then monetary policy transmission and credit mix. The first thing is rate cut transmitted faster. Usually the RBI also, monetary policy committee also focusing on the policy repo rates. If inflation is going on high level, the MPC will follow the contractionary monetary policy by increasing the repo rate. And if inflation is under control or there is a slowdown in the economy, monetary policy committee will cut the repo rate so that it will enhances the money supply in the economy, expansionary monetary policy. So whenever they feel that there is a particular room or space to cut the repo rate, they try to cut that repo rate, and they also want that the effect of this repo rate cut will directly help the end consumers. So EBLR, external benchmark lending rate, was followed in India, where the banks can follow the policy repo rates or 91 days T-bills or 182 days T-bill or any other rate decided by Financial Benchmark India. Uh, So here the external benchmark lending rate will now have the better effect that the rate cut benefits will pass on to the borrowers fastly. Second, non-bank finance gaining importance. NBFCs are getting more importance, and they are more flexible and better to serve MSMEs, retail borrowers, and niche and last mile segments. Now, NBFCs are also those who don't accept the check drawn on themselves. NBFCs are usually of two type. One is deposit accepting NBFCs and another are non-deposit accepting NBFCs. Generally, the majority of the NBFCs are basically the non-deposit accepting NBFCs. So they can't draw a check drawn on itself. So these NBFCs, they are promoting more formal bank lending, and more and prone, they are also promoting financial inclusion and supporting the MSME, retail borrowers, niche and last mile segments. If we talk about the corporates, this is a major change that can be asked in exam. Corporates are relying less on bank loans. That shows that they are by themselves, they are trying to raise the funds by issuing commercial paper or through corporate bonds. Commercial paper issued from between 7 days minimum to maximum 365 days. Commercial paper are issued by those companies who are having good net worth and good credit rating, usually in 5 lakh or multiples, and they can be easily endorsed as well. So large corporates are increasing using internal accruals, corporate bond and market borrowing, which reduces the pressure on bank balance sheets, and as a result of that, it improves the credit allocation efficiency as well. If we talk about the banking health, the gross NPA is at 2.2%, which shows that the strong asset quality, successful resolution of legacy NPAs through IBC codes, and better credit discipline, which also talk about the CIBIL score is actually now bank taken into consideration, and that too very seriously. Profitability, banks are reporting high profit due to their lower NPAs, high interest margin, that is their spread, and apart from that, reduced provisioning requirement. Now, there's a difference between gross NPA and net NPA. When the bank set aside some amount for provision purpose, that this amount can be used for NPA losses, that is provisioning actually. So if the banks are reducing this provisioning requirement, that means they will give more money for lending purpose, which will fetch more returns to them, and that also enhances their overall profit. Then credit growth stable. Credit growth is steady and broad based, not excessive. That means high demand for loan, absence of overheating, and economy is facing the financial stability as well. Now, let's talk about this is all about the internal sector of the economy. Let's move to the external sector, where export is showing resilience. Despite global slowdown, geopolitical tension, and weak external demand, Indian exports are stable. And what are the factors which help them? This is because of diversification. India is doing a lot of trade agreements with different world countries, and this shows that we are trying to diversify our export base. Then service export is the strongest one. And we are proudly saying this thing, that the service sector contribute a lot in our GDP and also promote a lot of our exports as well. So service surplus offset goods deficit. So even if there is a good deficits, that means the merchandise goods that we export, if there is an import more and export less, so service export is trying to make a balance out of it. So India ran a trade deficit in goods due to high import of crude oil, gold, capital goods. However, this is offset by large surplus in service trade, especially the IT and software business, business process management, professional and financial services. This helps a lot in overall segment. If we talk about the FDI is continuously rising. Recently, in last 5-6 months, it is actually falling a lot. But if we talk about the survey in chapter 1 context, it is rising, which talk about the long-term and stable capital. As you all know, FDI is for long-term purposes. That means any investment more than 10% in post-issue equity paid up capital on a fully diluted basis is considered as FDI. More stable, they will bring their technology, their research team, as well as they also establish their brick and mortar structure. Whereas FPI is basically passive investment. It is more volatile because FPI invests in stocks only, and once they feel that the returns are less in comparison to the other economies, they easily they withdraw their money and invest in different parts. So FPI are more volatile and they are sensitive for global interest rates. Suppose they are getting more returns in US bond, they'll withdraw their funds from India and invest there. So FPI global, focusing on global interest rates, and it is volatile as well. Monetary policy in advanced economies, as I told you that the US Fed, if they are providing more interest on bond, FPI withdraw their money from Indian market. Risk sentiments and geopolitical event also contribute in that. If we, this is again a extremely important part. If we talk about the forex position, 11-month import cover right now we are having. So import cover measure how long forex reserve can finance import. कितना ज्यादा फॉरेक्स रिजर्व है जो आपके इंपोर्ट को फाइनेंस कर सकता है. एंड 11-month इंपोर्ट कवर इंडिकेट वेरी स्ट्रॉन्ग एक्सटर्नल बफर, एबिलिटी टू हैंडल ट्रेड शॉक और कैपिटल आउटफ्लोज. 94% of external debt of India is covered through low external vulnerability, high capacity to meet external repayment obligation, and it also reduces the risk of balance of payment crisis. Now, what is balance of payment? Systematic record of all economic transaction done by the resident of one country with other countries, that is called as, with other part of the world, sorry, it is balance of payment, sum total of current capital and financial account. So it also reduces the BOP crisis. Now, let's talk about the labor market and social sector. Labor market, if we talk about, unemployment is declining thanks to the labor codes, focusing a lot on overall the gig workers, formal employment and informal employment. LFPR, labor force participation rate, is stabilizing. Then labor code is implemented, gig workers are recognized, poverty is actually reducing, and health and education indicators improve, which also talk about that the HDA ranking of India is little bit improving. So this is about the labor market and social sector. Technology part, the current government biggest contribution to the economy is digitalization, and we all agree on that. So Aadhaar, UPI, ONDC, One Nation Digital Commerce, has lowered the cost of transaction and financial intermediation, acting as a force multiplier for GDP. ट्रांजेक्शन कॉस्ट इंडिया में बहुत होता था, फाइनेंशियल इंटरमीडिएशन, साथ साथ में पेपर करेंसी, प्रिंटिंग ऑफ करेंसी कॉस्ट बहुत होता था. तो यहां पर आधार, यूपीआई, ओएनडीसी एक्चुअली हेल्प अ लॉट इन फोर्स मल्टीप्लायर फॉर जीडीपी. अ नेशनल कंप्लायंस रिडक्शन इनिशिएटिव हैज एलिमिनेटेड 630 redundant colonial era and bureaucratic hurdle, reduces the compliance burden for MSME. Usually MSMEs are always in this particular stress that we need to fulfill these compliances. So government is now focusing on this thing that the MSMEs, as we all know, are the engines of growth, and government focusing a lot on them, like Mudra Yojana or this one Vishwakarma Yojana, TREAD, RAMP scheme. All these are focusing on this MSME. So the most important thing is that compliance burden should also be need to be reduced for MSME. Now guys, these are some of the questions. You should pause the video, answer these questions in the comment, and find out how many questions you actually made correct from this chapter number 1. Consider the following statement regarding India's macroeconomic dynamics in financial year 2026. A Goldilocks growth phase implies that inflation is low primarily due to weak demand condition in the economy. No, Goldilocks में तो inflation stable है और growth stable है क्योंकि economy में demand बढ़ रही है, weak नहीं हो रही. The first statement is wrong. Second, sharp disinflation in India has been driven significantly by supply side factor such as food price correction and administrative intervention. This is true. A strong domestic demand led growth model reduces vulnerability to external shock compared to export led growth model. That's true. If you are focusing on a lot, or if you are relying a lot on export-led growth, then in that case, if there is uncertainty in the whole world, your economy might face vulnerability. But if there is strong demand growth or pent-up demand is increasing, it actually proved to be more beneficial. So in that case, statement 3 is also correct. So both statement 2 and statement 3 are correct, and statement 2 explains statement 1. Statement 1 is actually wrong. So both statement 2 and 3 are correct, but statement 3 explain 1. Only one of the statement 2 and 3 is correct and statement 1 is correct. Statement 2 and 3 are correct, but statement 1 is incorrect. So D is the correct statement. Next question. Which of the following explain the increasing decoupling between corporate investment and bank credit growth in India? Rise in internal accrual, that is correct, through commercial papers. Increasing resilience on corporate bond, true. Weak bank balance sheet, no, the bank balance sheet improved because of insolvency, bankruptcy, and these bad banks. So banks' assets are now proved more effective. This is wrong. Increased role of NBFC, this is true. So 1, 2, 4 A is the correct statement. Moving to question number 3. Despite a persistent goods trade deficit, India's external sector remains stable. Which of the following combination best explain this? Strong service trade surplus, true. High forex reserve with 11-month import cover, true. Rising FPI inflow providing stability. Now this is an issue. FPI inflows are not rising, they're actually decreasing. So they are not providing stability. FDI provides stability more. High coverage of external debt by reserve. This is true. So 1, 2, and 4 also is the correct statement. Next, which of the following best describe the concept of potential GDP? The highest level of output an economy can produce without causing upward pressure on inflation. The highest level of output an economy can produce when all factor of production operate at full capacity despite causing inflationary pressure. The total value of all final goods and services produced in an economy at current market price in continuous 2-quarter. The level of GDP measured in purchasing power parity. The correct statement is A. The highest level of output an economy can produce without causing upward pressure on inflation. That means highest output you produces without causing inflation pressure and use at full employment level. That is potential GDP. Last question, scheme, description, feature actually. EBLR, a faster transmission of monetary policy changes, true. Gross fixed capital formation, indicator of investment demand in economy. Service trade surplus offset mercantile trade deficit, true. Import cover reflect ability to sustain fiscal deficit. No, import cover help to sustain the BOP crisis. This is wrong. Correct answer is only 3. 3 pairs are correctly matched. So that's all in this particular chapter number 1. I hope you all get a good knowledge from chapter number 1. This is how we cover the rest of the chapters, and hopefully you all get a lot of insights from this particular session, how to read the economic survey and what all things are relevant for exam. So that's it from my side. Again, I'm saying this thing, I'm covering more of this economic survey with reference to prelims 2026 because reading this bulky document is quite difficult for the aspirants. So I'm trying to cover as much as possible which is more relevant for you people, and this is my personal intake from this economic survey. That's it from my side. Thank you and God bless you all.